Today we're joined by John Hill of First Reserve. John, welcome to PrivCap today. Thanks for being here.
Good to be here.
So First Reserve, obviously one of the major investors in energy,
Right.
And all aspects of energy. Let's talk a bit about what you're seeing in the market today. First Reserve has been through many cycles in the economy and in the energy industry. What is different about today's energy price swoon from previous down cycles?
Yeah, in many ways it's similar to other cycles, but they have different reasons for the cycles. I guess this is my third trip through these major upheavals in the cycle since we started First Reserve in the early 80s. In the 80 downturn, it was really driven by a collapse in demand, particularly in the OECD countries, which were the principal consumers of petroleum in those days. The 90s was driven by a drop in demand as well. And then even more recently, the 2009 collapse in prices was a drop in demand. Today's cycle is driven by an increase in supply. This is really a supply issue, created by and large by the shale play. Now let's face it, oil production is increasing all over the world, but it was that increment of shale which really destabilized this market and led the Saudis to the position that they really had to go back and try to protect their market share. The 80s, there were probably more bankruptcies. 500,000 people lost their jobs. Hundreds of companies went into bankruptcy. There were even big banks that failed in the 80s. We don't see that happening this time. Sure, there's going to be a lot of bankruptcies in the E&P space and in the service and equipment space, but nothing near the number. People are losing their jobs, but it won't be 500,000 people. So I think it's going to be less of a severe downturn than what we saw in the 80s, probably something more like we saw in the 90s, less impact.
Question for you about infrastructure. Clearly demand is rising in Asia and will continue to rise. The U.S. now has a lot more, especially natural gas, than it used to, and it has the capability to produce so much more. How do we get it from the U.S. to the Asian markets?
Infrastructure is a big issue in the industry. Even with this downturn in capital spending for exploration and development worldwide, infrastructure is still short relative to what is needed to move oil and gas from where it's found to where it's going to be consumed. As my colleague Kathleen Ellsworth once noted, the dinosaurs didn't know where to die. Okay, so it's infrastructure in the U.S., all this new gas play in the east, all this new oil shale play in the west. It requires just a lot of new pipe, a lot of new compressors, a lot of new infrastructure to move it to markets. But that's true worldwide. All the discoveries in Africa, all the discoveries in Brazil, oil's not being consumed there. It's got to go elsewhere, so you need infrastructure there.
As you look at various players within the energy landscape, where do you see certain kinds of businesses poised to sort of snap back to roughly where they were before the swoon? And which aspects of the industry do you think have permanently changed? You know,
I don't think anything's going to snap back anytime soon. We're seeing more of a gradual recovery as prices sort of move from today's level, which we think they've sort of stabilized at. As they move towards the $55 to $65 level towards as we approach 2020, we think there'll be a gradual recovery in the industry as cash flows improve, capital spending improves. But I do think there are some companies poised to benefit from this and others that won't. Obviously, small, over-leveraged companies aren't going to make it. We think most of the washout will occur by the end of this year. But if you look at the majors, the integrated, they're fine. They'll get through this and probably find ways to benefit from it in terms of acquisitions. And the large independents, they're fine. Sure, they've got constrained cash flows as well, but they've been able to tap some equity markets to rebalance their balance sheets, and we think they're going to be the ones that be the most interesting place to be in this space going forward. Will be independents with good balance sheets, good cash, good liquidity, good management.
Where do you, as a private equity investor, make money in a market that you say is sort of gradually recovering? What's the most interesting play for you?
I think the most interesting play for us, first of all, it starts with good management teams. You have to back good management. I've said for years the biggest, most scarce thing in our industry in energy is good management. So you need people who are technically competent, but who also are good managers of capital-intensive businesses. You have people who understand economics and what rate of return means. So first and foremost, teaming up with good management teams. But secondly, doing so in areas with what we call good rocks. If you look at some of the shale plays in the western United States, Permian Basin, for example, there are great areas in there that you want to be exposed to as this recovery starts to occur. You have the same in natural gas in the eastern United States. Even at today's prices, there's some attractive plays in the natural gas space in the Utica Shale and the Marcellus Shale in the east. So those are a big priority for us right now.
And you say so, sorry to interrupt, you say so because it's less expensive to extract the energy from those rocks?
All shale plays are not alike. Some are very productive at today's prices, very cost effective in terms of rates of return, some are not. But that's the key. You can produce some of these areas because of the new technology, the hydraulic fracturing on horizontal long reaches. You can produce these at reasonable prices, and as prices recover, the margin's going to expand even on these things that are somewhat profitable today. So it's going to be a good business, and that's what we're usually after. We're looking for investing in companies that can grow their production, grow their profitability, grow their margins, and grow their cash flow.
You mentioned fracking technology. Clearly, the abundance of oil and gas in the U.S. now is the product of technological breakthroughs. What technologies are you looking at very closely now that you think will make a big impact on future profits in this industry?
I think the big technological impact in terms of at least oil and gas has already occurred, and that's the application of big data, high-speed computers to this fracking, to hydraulic fracturing, which we've been doing for years, but just never knew how to do it on these long reaches.
Maybe back to your deal flow in today's market. What does it look like?
The deal flow has been strong for the last 18 months since prices collapsed. On the other hand, it's only recently that we've begun to see deals that look reasonable. Sellers are just now starting to finally get realistic on valuations. That wasn't true the last 18 months. We've also had great relationships with some of the majors, with Shell, Schlumberger. We've done joint ventures with them. That'll continue to be a part of our business.
But what makes you most excited to be a private equity investor in today's environment, given that you've been doing it for 30 years?
I think what's most exciting to me is we have an opportunity to put some money to work at. It's clearly what is a part of a low point in these cycles that ripple through this industry, every 10 or 15 years. It's nice to say we can be pricing E&P purchases or asset purchases today on today's forward strip, which is materially lower than it was 3 years ago, 4 years ago. So it's a case where, with good management, with good rocks, you can earn a decent return.